Hello, everybody. I hope you all had a great Thanksgiving weekend and you and your families are doing well. I'm Harold Kaplan of the law firm of Foley and Lardner. I'm one of the co-chairs of this conference, and Foley is one of the law firm sponsors of the conference, along with Kirkland and Ellis, Milbank, and Morrison Forster. I want to welcome you to the 27th annual Baird Group Distressed Investing Conference. This is the first and therefore longest running distressed investing conference around. This conference has been a labor of love for many of us in the restructuring and investment community for over the years. And we have to thank the Baird Group, Peter Chapman, Trouble Company, Reporter and Prospector, and Turnaround and Workouts for continuing the tradition in these unusual and stressful times. I have to admit that this year feels different. In prior years, the conference was an intimate in-person gathering of leaders and up-and-comers in the industry who enjoyed the networking and a good amount of self-congratulatory schmoozing. This year, we are virtual. The networking is tougher, but the attendance is far larger and as august. And the conference price could not be beat. Thanks again, Peter and Baird Group. By the way, Baird Group is investigating offering follow-up breakout sessions at some later date for panelists and attendees of the conference who missed the networking. Having said that, this year's conference continues at its high star quality level and in some ways is better than ever. We have a number of new faces, leaders, and sponsors. I would particularly like to welcome on board as a lead sponsor and co-chair, Josh Sussberg of Kirkland and Ellis and Kirkland and Ellis. In so many ways, 2020 has been the year of Kirkland and Josh. Josh has handled everything from McDermott International to Denbury and a host of other major oil and gas cases to JCPenney and others in retail. Also, Aon and Gary Blitz bring a new perspective on risk management and insurance in distressed situations as a new conference sponsor and co-chair. We also are benefiting from the conference being virtual insofar as panelists and attendees could make the conference from all over the country instead of having to get to or back to New York the Monday morning following Thanksgiving weekend. This has also minimized the traditional belly aching about the timing of the conference that the organizers had to endure year after year. Now, I'd like to talk about the conference agenda and timetable. Unlike prior years, jam-packed, forced March one-dayers, this year's conference is spread over 3 days for several hours a day. So hopefully everyone can attend whatever sessions you want to. Starting today, after I get done reminiscing, we have 3 great sessions. First, we start with the year in review and new opportunities with our longtime friend and distressed investing sage, Steve Gidumal of Virtus Capital. This session is always our kickoff and one of our most looked forward to sessions. Next, at noon Eastern, we move to the retail investing and restructuring panel moderated by Josh Sussberg of Kirkland and his all-star panel who have been central players in so many of the major retail cases. Finally, at 1 p.m., we have the panel on new subchapter 5, the small business restructuring section, and opportunities in the pandemic. It's moderated by Bill Brandt. Bill is always my nominee as the most interesting, or at least the most entertaining man in restructuring, with or without a corona beer or virus. Rounding out this great panel, Bill is further joined by U.S. Trustee Harrington, Bob Keach, and Chief Judge Morris. In the next 2 days, the conference starts at 11 a.m. Eastern and continues to have can't be missed sessions. So please refer to your conference agenda. Just an overview, tomorrow includes the annual Harvey Miller Award to an interview with Lisa Donahue of Alex Partners, followed by a panel on bringing certainty to distressed deals through insurance risk solutions organized by Aon, then followed by a great panel on volatility and valuation in the oil patch, moderated by my Houston partner, John Melko, and including lead players in today's oil and gas cases. Wednesday continues the trend, starting with a can't miss session with remarks from Jamie Spray-Regan of Kirkland, who has probably been the most influential restructuring lawyer of the last decade or generation. That's followed by the Investors Roundtable, a panel on underwriters and covenants in the pandemic, a session on distressed hospital sales, and ending with our annual recognition awards to Turnaround and Workout's outstanding young restructuring lawyers. As is the case every year, the goal of the conference is to ask where we have been, and more important, where we are going in the distressed investing and restructuring industry. Each year, I have to remind myself that we are all like the 5 blind Indian sages asked to describe an elephant based upon each feeling a different part. Just like them, each of us tends to perceive things based on what we do and have most recently experienced. In my case, the last year has been mostly representing indenture trustees and bondholder interests, as well as oil and gas suppliers, generally in very large capital market cases with billions of dollars of debt, if no longer as much value. These included JCPenney, Chesapeake, and Hertz. The latter two each involve representation of over $2.5 billion of unsecured debt. Enormous numbers. I remember when I used to brag about representing more than $10 million of bonds in any case. The cases this year have been predominantly in oil and gas, retail, and healthcare, areas we're covering very extensively in this conference. We're also, I think, looking for increasing projected exposure in such sectors as restaurants, transportation, hotels, and commercial real estate. The cases have been increasingly, some days it seems almost exclusively, filed in Houston, although Delaware, New York, and Richmond, particularly for retail cases, are getting their more than fair share. Most cases are heavily negotiated, pre-filing, and are being filed with RSAs or prepackaged plans, even though they are seldom as prepackaged as advertised. As an aside, when this conference started a quarter century ago, the term pre-pack meant to some of us packing your litigation bag with case documents the night before running to the 6 a.m. plane for a 9:30 meeting, usually in downtown New York. There was no TSA and little delay, and I often, upon arriving at the airport or returning to O'Hare, got to wave at friends and still conference stalwarts like Bill Brandt, Jack Butler, David Kurtz, and Jamie Spray-Regan. With so much pre-filing preparation going on, cases seem to be on a shorter track, with somewhat less formality of notice and process, including in the case of approving settlements, and certainly less opportunity for non-sponsors to influence the ultimate outcomes. And as we all know, hearings have been virtual and call-in, including allowing some professionals to appear at multiple hearings in different cities on the same day. My prediction is more of the same, with a possible temporary slowdown or breather now for a month or two, and then an uptick in the first part of next year, as sectors and businesses negatively affected by the pandemic and commodity volatility and other factors hit. From a lifestyle perspective, I think that web call-ins to hearings with hundreds of participants are here to stay, although central participants in particular hearings, particularly lead counsel and witnesses may need to appear in person. Having said that, what do I know? It's all conjecture. With that, I would like to turn over the conference to someone who does know a lot. My old friend Steve Gidumal of Virtus Capital. He's one of the great distressed investors and prognosticators, and he's a longtime friend of the conference and star of the conference. So without further ado, let me turn this over to Steve Gidumal.
The retail industry has seen, they saw at least 40 major retailers file for bankruptcy this year. Many among the most famous names in the United States retail, U.S. retail: Brooks Brothers, Neiman Marcus, Lord & Taylor. I think my mother was shopping at that from the 30s and 40s, for goodness sakes. J.C. Penney, J. Crew, Guitar Center, GNC, the vitamin company, all filed for bankruptcy this year. They were expecting that there are approximately 25,000 store closings this year in the retail industry. And we have a slide about that later. We'll talk a little bit about that. Restaurants also had a very rough year, and they're still having a rough year. And obviously that's a source of much topic here as we're just finishing the Thanksgiving holiday. The sales decline, let's look at the monthly sales decline. In March, down 27%. In April, down 52% year over year. So April sales for the restaurant industry in April 2019 versus were 52% higher than they were this year in 2020. May down 38%, and June was down 26%. I have data up through July. Obviously, it takes a few months to roll this data in. Obviously, lockdowns have killed the industry, and the restaurant trade groups are estimating that up to 30% of restaurants in the country could close this year. With no travel across the planet, oil and gas producers suffered, as you would imagine. 36 oil and gas producers that we'd call major, mid-majors to major O&G producers filed for bankruptcy this year with a total of $51 billion in debt. And I'm sure if we actually had everybody in the room, many in the room would have worked on these restructurings. So besides that, Mrs. Lincoln, how did you like the play? So why is the Dow breaking 30,000 in a COVID world? I mean, it's crazy, right? I mean, so the play was good, I guess, right? The stock market saw good news through all the chaos. It's inexplicable. Inflation and interest rates. And so here's my attempt at trying to explain the seemingly unexplainable. Inflation and interest rates remained low. The 30-year yields this year bounced around between 109%, which is about the low after the COVID announcements, when things really started to take form in late February, early March. And then they've recently risen to about 1.75 as the world is somewhat coming out of lockdowns. And obviously, there are many steps were taken on a national level from the Fed policy standpoint, where we with the COVID relief programs, I think it was the PPP, which stimulated the economy with $5 to $6 trillion at this point, with probably more coming next year, another $2 billion, according to Nancy Pelosi. So this at some point is going to be inflationary to the U.S. economy. I have been saying that for 3 years, that there's some of the things going on in the country, if not actually 10 years, are inflationary. We'll see how that goes, but in our firm, we have a short on the 30-year Treasury bill. We're able to borrow that, I think, at 1.3%, 30-year money. I mean, think about it. And so 30 years from now, we'll be happy to pay that back. But I'm expecting, so if interest rates go up to 3%, for example, you pretty much cut the value of that bond in half. So I think, to me, that looks like a pretty interesting investment opportunity. The Trump foreign policies actually brought peace throughout the world. I mean, I know it doesn't get any coverage. some of you people hearing this maybe for the first time, all you New York Times readers and CNN viewers, you wouldn't even know about this. Trump exploited the rift between the Shiite Muslims and the Sunni Muslims, and he did that with very high effectiveness. The Trump administration signed peace deals with Israel, Bahrain, and Israel and UAE. I mean, those countries signed them, but we sort of were in the middle of that. And then unexpectedly, Serbia, Kosovo, which is, if the others are too politically charged, how about Serbia, Kosovo? That seems like a real Nobel Prize sort of winning situation. And interestingly, I'll just give a shout out to a distressed industry lawyer, David Friedman, who is our ambassador to Israel. And again, if everyone was in the room, a lot of you in the room would know David personally. I've told people in my circle that he was actually always a debtor's attorney. So on the creditor side, in most bond cases, we wouldn't have the opportunity to hire David because he'd already be gobbled up by the debtor in possession. But there was at least one chance. One time, myself and a group of bondholders were able to hire David, and brilliant guy. I'm not surprised that I would be shocked if he didn't have a hand in some of these peace deals. So why is that important? Why mention that in a distress conference? If we see that the Arab world has now splintered into the two groups, and the Sunni side is signing peace agreements with Israel, and I'm sure if Trump had won re-election, and maybe he still will, we'll see, but that's not even touching that. I would have expected a Saudi Arabia peace deal to be announced between Saudi Arabia and Israel by January, February of next year. And sure enough, we've already heard that Netanyahu has flown over to meet the king of Saudi Arabia. They're clearly signaling that there's a divide, and they're lining up sort of the peaceful nations against sort of the hegemony of Iran, supported by the Russians and the Cubans. So if we now understand there's this rift in the Arab world, that there's peace coming to the Middle East, that has to lower the world's investment discount rate. And that's why I mention it here. So I'm just trying to explain why the Dow is at 30,000 in such an unusual year. So somebody like that play, not maybe Mrs. Lincoln. The North Korea has been sort of sitting on the sidelines. I know people criticize Mr. President Trump for his trips out there, but they seem to be working. I mean, Sun Yun Kim is not flying missiles over Japan as he used to do just 4 or 5 years ago. The sanctions and the strong U.S. enforcement have put pressure on Iran's economy. There's no question about that. And sort of this anti-Russian hoax thing with President Trump encouraging drilling in oil and gas has kept U.S. oil and gas prices low relative to 4 or 5 years ago. Actually, for starting 4 years ago and then going 8 years back when U.S. Gas prices were very high. We did analysis. I think I realized this that gas actually hit $8 a gallon in, I think it was 2010, when they were clamping down on fracking in the United States. Just 2 weeks ago, I filled up, maybe it was last week, I filled up $2.10 a gallon. That's a big change to basically the heartland of this country. If you're driving 20 miles a week, you're talking about savings of $120 a week. That's like $6,000 a year if you're driving that much, between $8 and $2. The gasoline at the pump under the prior administration averaged about $3.54 and fell to $2.67 under President Trump, about a 25% price reduction, which puts money directly into people's pockets. U.S. employment was at record high levels, while unemployment was at record low levels. And of course, we've heard about specific minority groups at historically low unemployment rates, which in a sense should be very positive for peace in the United States. The case of the U.S. southern border died down, and I think President Trump and the Trump administration didn't get enough credit for this. where they actually were holding the migrants on the Mexican side of the border, so that they wouldn't be released by judges into the mainland United States, keeping them on the Mexico side and letting that country handle that. So that maybe is why the play was so good for Mrs. Lincoln. But on the negative, because this is a year of much more negatives than positives. Amazon and COVID crushed the retail sector once again. Amazon once again, and COVID crushed the retail sector. We mentioned about some of the bankruptcies and retailers filing for bankruptcy this year and the store closures. Here's a list of I think I have 14 here, just picked from the more known or better known, particularly to this audience. JCPenney, we've all expected that to happen for the last 10 years, and it's finally happened. 242 stores will likely be closed. Neiman Marcus, they just had a tough, that upscale luxury niche is a tough niche when you could buy stuff so easily via Amazon. Brooks Brother, real sad event. But again, with people not wearing suits and ties anymore, that was a tough, they had to see the writing on the wall. So they're closing about 125 stores. Lord & Taylor's is closing all 38 of their stores. GNC Vitamins, I think, has about 4,800 to 5,000 stores. They're closing almost a quarter of them for 1,200 of the stores. J. Crew says they're going to try and close no stores, yet at the same time they issue press releases saying they need to get out of unfavorable leases. So let's call that 25 or less. It might be 25 or more. Ascena Retail is closing 500 stores. Ascena is better known for being the parent company of Lane Bryant and Ann Taylor, and also Loft. So they're going to close 500, I think, out of 2,500. But there are stories in the paper the last couple of days that there's a private equity fund that's circling around that company and looking to make a deal to buy them out of bankruptcy. Guitar Center is probably going to close 500 stores. That's a competitive market. You would think that maybe people playing music at home would be a stronger market this year. But again, that's a market that Amazon can just decimate when you can, when you know the guitar you want, you just order it online and deliver it to you. Century 21, a favorite of many younger professionals in New York City, because it's right down there by Wall Street, is closing 13 stores. I'm not sure the Wall Street one will close. We're watching that. Stein Mart, I actually have never shopped in a Stein Mart, not really sure what that is, but there's 281 stores of that have closed. And Taylor Brands, which is the men's warehouse in Joseph A. Banks, is closing 500 stores. And it's interesting because just 2 years ago, or maybe 3 years ago, 97, 98, Men's Warehouse and Joseph A. Banks merged in a merger that was not supported by the CEO founder of Men's Warehouse. He was against the merger. But at the time, it seemed like both these companies had really no other choice. They couldn't keep fighting each other in key markets. They were in the inner city market, Manhattan, Philadelphia. They couldn't keep blasting each other with price cuts and hope to survive. So they merged, hopefully giving themselves some price relief, but it just wasn't enough. And I'm sure that was a casualty of COVID. Pier 1 Imports is going to close about 300 stores. That's been talked about for a couple of years, so that's not completely surprising. And Lucky Brand, which is a jean company with not many stores, but they're going to close about 25 stores. There's one in the Soho location just off Broadway and here in New York City. Not clear if that one's going to close. And Sur La Table is going to close about 51 stores. On this slide alone, I have 3,800 stores of the 25,000 stores closing are identified with the company. So that's a pretty representative cross section. On the energy side, the biggest energy company to go bankrupt, and this has been expected for several years, is Chesapeake Energy. The founder of Chesapeake Energy several years ago, as most of you in the audience know, either lost control of his car or drove his car into a brick wall at the face of a tunnel, I believe it was, and was killed. And that was when the fortunes of the company were changing and the debt load was way high, and he had borrowed against some of his stock, and it was a messy situation. A friend of mine who lives in Houston says, and who knew him, said he was a really great guy, and that's a shame to lose someone that innovative. And that was several years ago. But now the company itself has filed, and then they'll have to reformulate themselves. So that was $11.8 billion of debt. California Resources, another producer, $6.3 billion of debt. Ultra Petroleum, $5.6 billion. Whiting Petroleum, $3.6 billion. Chaparral Energy, $3.5 billion of debt. And Denbury Resources. And I'm pretty sure that an oil and gas analyst at Bear Stearns that I worked with had become the CFO of that company several years ago, or maybe it was Sternbridge, but they were doing something with Denbury, either buying or whatever, and that company has now filed. Above are shown 6 of the 38 oil and gas bankruptcies and 33 billion of the estimated 51 billion. So let's talk about the wild market action of COVID 2020. And here, these are all distressed names if you want to consider it like that. And you'll see just how volatile the year was. So the Dow hit 29,380 on February 6th. It looked like we were going to cross 30,000 probably before April 1st. And then started falling on the COVID news. Just to remind everybody, I think President Trump slapped the restrictions on travel from China on January 31st. But again, was being criticized for that. So this was 6 days later, it about hit the peak. It was a slightly higher by February 12th, by just like 120 points or whatever. But I'm using the February 6th because by that time, that's really when the world was really focused on what's this COVID situation. By February 12th, I think people had already absorbed it. And I think the market was just trying to do a little bit of a rally by the 12th. So you can pick either day as your high for the year, but we're high for that time of year. We're going with the February 6th number, 6 dates. So let's take a look. So Pfizer at that date was at 35. And then the low point of the market was in fact March 23rd. It was a Thursday. No, I'm sorry, it was a Monday. It was a Monday. And it hit, Pfizer wasn't really that effective. It went from 35 down to 26. And it wasn't really affect that much on the upside. So it's at 36.5 today, even with the news of the COVID vaccine. So basically, for the entire year, Pfizer's just up 3.5%, 3.7%, which is really surprised me actually when I first looked at it. And I guess that maybe goes into issues of the portfolio, more the portfolio of Pfizer. And some analysts are saying that the vaccine itself may or may not be that profitable for them because if it's a one and done kind of thing, you make your money this year, but it's not, you can't put it into your annual cash flows. Well, that's to be determined. Conversely, Moderna, which was not as well-known pharmaceutical company, started the year at started the year a little bit lower than $19, but on February 6th was at $19.88. And on March 23rd, was already up to $26 because even by then there were already rumors that Moderna was a stock to look at because they had something going on with COVID, on a COVID vaccine. Here it is in November 25th, it's stocks at 109. And as most of you people in the audience know, this has been one of the great stocks of this year. They're up 550% for the year, at least 550% for this period of time. They were a little lower at the beginning of the year, but not much lower. So that's been a real success story for that company. Amazon, as of February 6th, was at $2,000. It only went down to $1,900 by the end of the low point in March, and today has rebounded strongly up to almost $3,200, and that's a Tuesday price. Disney was at 142 at the beginning of the year, fell down to 85 because lockdowns affect the theme park business and, frankly, the movie theater business where they sell their movies into. And now it's rallied back to 149. let's compare that to Coca-Cola. So Coca-Cola at the February 6th date was at 57.50 roughly, and fell down to almost $37, and now it's at 52.93. So okay, so Coke has not really rallied back all the way to its highs of February 6th. Yet Disney has passed the highs of February 6th. Which of those two companies do you think is going to be less impacted by what chaos could happen in the next 6 to 12 months? Frankly, my money would be on Coca-Cola, and we still own the stock today. We bought it right around, because again, we had the benefit of not being Dow investors, but by the time you're looking at March 23rd, everything in the world was distressed. So we were like, okay, with the world going to hell, we took a fresh look at Disney, Coca-Cola, McDonald's, ExxonMobil, and tried to and felt very comfortable putting them into a distressed portfolio. Coca-Cola has 3 revenue streams. It's the restaurant business is important to them. Actually, movie theater is also important, and then obviously grocery stores. When I say restaurants and bars. Obviously, with restaurants closed and bars closed and movie theaters closed, they're still affected by 2 of those. But the grocery market is still very, very much available to them. And I think that's another reason that has rallied back. Disney, by comparison, the theme parks is a huge part of their business. It's 1/3 of their revenue. And then the movie industry is also very important to them. And both of those are essentially still shut down. The third one is all the TV streaming, the Disney Channel, ESPN. And it's not Netflix. It's an okay, but it's probably the one industry that Disney is probably a second player, not a premier player as they are in movies and certainly in theme parks. McDonald's, interestingly enough, was at $209, and then went to down as low as $135 when all the stores look like they're closing. But again, many years ago they put in all these drive-throughs through almost every restaurant in their portfolio, and they simplified their menu. They got out of the breakfast, which some of the franchisees have been wanting to do for years, and because it makes their morning so complicated. It was breakfast all day. That's what's made it complicated. And so they simplified the menu. You can't get breakfast after 11 o'clock. College students everywhere are crying about that. But you can drive through and get whatever else you want. And now the stocks rally back to about 219. So it's up about 5% during that period of time. Delta Airlines, another one we should talk about because we're going to compare Delta to ExxonMobil, the one below it. Delta Airlines started the year at 57.78, on February 6th was basically 57.78. By contrast, Exxon was 57.30, so we're sort of at the same stock price there for a moment. By March 23rd, Delta had fallen more than Exxon. It went down to 22, and Exxon was hovering around 30. On Tuesday, Delta had rallied back to $41, so it's still down 28.5%. And Exxon has rallied back to also $40, actually slightly lower, $40.81 versus $41.29. I'm asking, from an investor standpoint, who has more ups? If the upside is represented by the peak of February 6th, so they both have upside back to 57 with the cash flow streams that investors viewed it as of early February, who is more likely to get back those cash flow streams? ExxonMobil, the gigantic oil major, super major, or Delta Airlines, which is a very successful airline in the United States and internationally. Obviously, both have something in common, their need for oil. I mean, if there's no usage of oil, then if the airlines aren't using oil, then Exxon's not going to sell oil, and certainly their jet fuel. And there are problems actually of capacity of jet fuel right now. They're burning some of that off. But people everywhere are driving, and they're not flying. I mean, they are flying, but not to the level they were. We like Exxon over Delta at this point, but obviously investors can make their own decisions. Similarly, Carnival Cruise, so $43 at the beginning, at the peak of February, went down to 12. It's come back to 20. That's still half the price. It's down 52% during that period. There's still a lot of risk there. I think I'd rather take my upside on the ExxonMobil side than on Carnival Cruise. Who knows when those are going to be opened up and if they'll ever come back to the way they were. But obviously we're rooting for them as we're rooting for everybody. COVID with 2020 vision. That's a heartbreaking year. Okay, so this was a year with many unanswered questions that will probably have to be studied for decades. So one question, did China unleash the the virus from Wuhan to stop the U.S.-China trade war? I mean, a few people think that that's a possibility. I have no position on that, but, you know, it's interesting to think. I mean, one point is that they have not traced they still haven't traced the source of the virus back to an animal source. I think on SARS they did that in 6 months or 3 to 6 months. It's been almost a year now, and they have not been able to do that, which would suggest that it was manufactured synthetically, and then to what purpose? Why was that done? If it was done, would the death toll in the United States have been lower if the NIH, the CDC, and the FDA advocated the use of hydroxychloroquine? This is one of my big beefs. It's like you look at the death rates in Africa, where because of the malaria, a lot of people, the population, are on hydroxychloroquine. It's a very inexpensive pill. It's like $1 a tablet. It's been FDA approved for over 50 years. If we had the thing that made me so curious about this is that there was such a backlash on the left against the usage of hydroxychloroquine, and yet none of the studies that so-called proved that it had no impact were really properly done. And there were studies that were properly done that said there could be some impact on it if you caught it early on. So the question is, should the entire U.S. population be sent a 5-pack of the hydroxychloroquine pills? It's a $5 pill, $5 for a week or 5 days. Everybody take a pill, one a day, and would our death rates and our infection rates have been much lower? Someday we'll know the answer to that. It may take 10 years to figure that out, and we have to get out of this politicized environment. But I do think that that's an unfortunate miss. Does okay, so then now we get to some economic issues. Does the economy work if no one is working? It's a fascinating issue to be studied by economists, that we always talk about if people work and then don't spend but save so they can take cash and then put it into investing, right, that we make an economy more powerful, more effective. There's already analysis out there that says the U.S. savings rate has actually gone up. I mean, no one's working, yet the savings rate in the United States has increased. So that's really kind of an interesting thing. Does that mean, in fact, that down the road, in the next year or two, we might actually have a stronger economy because we're investing more on that we've saved more and therefore have more money to invest? I'm not sure. I mean, I think that with so much economy in lockdown and so many people not working, really, how do we pay for all this? And then how do those people sort of dig their way out of the hole that this COVID and lockdowns have put each of those particular families in? But economists, man, if I was, economist born this year, somebody get really into economics, when he comes of age 30, he might be right at the time to study this issue and give us some real answers. I mean, we're still talking about stuff in the 1919 pandemic, and then also people still trying to get their hands around what caused the market crash in 1929. So this will take some time to sort out, but it's worth for the right kind of person to dig into it. In the lockdown economy, this thing sort of bugged me a little bit, is that did we see the true delineation between essential jobs, doctors, teachers, EMT, nurses, police, firemen, military, food and house care producers, transportation workers, IT workers, supermarket personnel, energy personnel, lawyers, and to file the bankruptcies, and non-essential jobs, admin workers, government workers, foreign service, upscale services like restaurants, bars, and gyms. I'm not saying these are sort of not useful jobs, but these were jobs that are sort of a little less essential, that maybe more appropriate for an economy that's hitting on all cylinders like we were in February. But do you need that as an economy? If you're struggling, do you need these jobs? And that leads to the next point, is that it still is, we're, one of our business has a lot of house renovation company properties, and this is the time of year we're sending out tax bills. We're paying our school tax bills. It's just crazy to have these, property tax bills paid over and over, and the teachers aren't working. I mean, so it seems like we've created this dual economy where the public sector has been paid throughout this crisis, and the private sector is taking it on the chin. But the private sector is supposed to fund the private sector, and I don't think there's any state government that has done this properly. At the federal level, we could have probably done more too, but it was an election year making everything difficult. Going back to my comment about the hydroxychloroquine, this slide is hydroxy, Winoxy. The unrelenting attacks on long-time FDA that seemed to practically prevent infection made no sense. And the point of this slide is really look at the first line. Africa, population 1.216 billion people, and the COVID deaths are 50,000. It's 0.004%. And I don't think it's because they had all these programs that we have in the U.S. and everyone's wearing masks. I think it's probably because they prophylactically were taking the malaria pill, and it was proven to be somewhat effective as a prophylactic. I mean, it's a crazy, crazy number. And then you have Sweden, which didn't have a lockdown, at 6,000 deaths for their 10 million people population. It's a very homogenous population also, by the way, so you got to factor that in a little bit. And that's 0.065%. And the United States population, still one of the better countries, 328 million people. We had 261,000 deaths. This was, I think, as of Tuesday. Still is a very sad 0.079%. And that's percent, so that the real number would be 0.00079, and then multiply that by whatever number. So I think that's really about one person in less than 3/4 of a person per 10,000 people. Italy was said to be bad, and their numbers, if they're accurate, are a little bit worse than the United States. And Europe in general, with almost 740 million people, has about 1.4 million deaths for about a 0.19% death rate. And that's much worse than what's going on in the United States. So this leads us a little bit into this whole issue with China. Can the trade war with China continue? The Dow, our Dow started the year at 28,500. The Hang Seng started roughly, just coincidentally, similar, 28,000, almost 200. Our stock market now, as of yesterday, what day is today? Saturday? Yeah. On Friday, as of Friday, was up 4.8% for the year. The Hang Seng is down 4.6%. It's about a 10% swing. However, and part of the reason may be because the Chinese government has been strengthening the yuan, so they're reducing the U.S. buying power. I mean, I'm sure that's very thought out by the Chinese government. I think they're trying to make it decrease the U.S.'s buying advantage. The question will be, is their currency just naturally stronger right now, or are they propping it up? It's always the issue, and with how the yuan reacts on a world level. If it's not naturally stronger against the U.S., then they're going to have to stop this at some point, because you can't prop up a currency forever. If it's a natural reaction, then I'm not sure why that is, because it would seem our economy is doing better than most. There are words that China's back to normal. They're not doing the lockdowns, and that could very well be. At one point, I would say is that we did hit a high. The U.S. buying power hit a high on May 27th, where the dollar was almost 7.2, and now it's 6.6. So that's a big drop off from May to now, in 6 months. These are interesting. Okay, so struggling with COVID. I think it's a really interesting, we talked about Disney and some of these other, quote, distressed companies, because this year everything is distressed. Let's look at some of let's just a straight comparison between the 3 months ago last year and 3 months this year. So this is the April to June quarter, when probably Disney was hit the hardest. The 3 months of 2019, they had revenue of 20 billion, because these numbers are in millions, so it's 20 billion of revenue. This year is about half of that, 11.8 billion. The costs and expenses are as you see them, and let's go right to the bottom line. So last year for the 3 months ending June, Disney made $1.6 billion. This year they're going to lose $4.5 billion. And it's most of it's on the revenue. Of course, it's on the revenue line. Struggling with COVID, Delta, Airlines. Everybody's fascinated about the airlines. Let's take a look at them. Revenue, $12.6 billion between July and September of last year, that's travels. That's right, vacation season, right? The whole world's traveling in August. In the United States, we start in July. And September, everybody's got to get back to work. Last year, they $12.6 billion revenue. This year, $3 billion in revenue. So down by 3/4. The income last year was 1.5 billion for Delta, which is a very strong performance for that company. And this year they're down $5.4 billion. They lost $5.4 billion in just 3 months. And now, can they survive? So this one, let's look at the cash and the debt. So last year, Delta had cash on hand of almost $3 billion, $2.9 billion. And they had debt of about $12 billion. This year, the cash has gone up to 21 billion cash on hand, which is very sensible. That's a CFO who probably was very proactive to get to raise the cash from banks or in the bond market. However he did it, for $21.5 billion of cash sits on his balance sheet. However, he does have $35 billion of debt. Now, so he's probably got, I don't know, if you're burning $5 billion a quarter, what do you got, a year? He could suffer the same kind of lockdown as he did for the third quarter for 4 more quarters. I mean, maybe, but then he'd have almost no cash and still 35 billion of debt. So obviously, Delta needs this the lockdowns to end, and people they may benefit they will be a big beneficiary if the vaccines work. Now, Carnival Cruise was one of the first companies that was on the cutting edge of this, interestingly enough. And remember, way back in February, March, we heard those stories, might even start in January, of people on a boat that were sick, and then no country was allowing them into port. And there was a couple cruise ships like that. Well, the quarter that went from June 1st to August 31st of this year, compared to last year they did $6.5 billion in revenue, which is spectacular. Their income was almost $1.8 billion last year. This year they had $31 million of revenue versus $6.5 billion last year. $31 million. I think we had law firms that did that kind of revenue for 1 quarter on the bankruptcy side. The expenses were 2.4 billion roughly, and they lost $2.9 billion for 1 quarter. Now let's look at their cash reserves. Last year they kept a comfortable $500 million in cash, 518 million, and they had debt of about 11.5 billion. Now they put the cash on the balance sheet while they could get it. They have $8.2 billion in cash and almost $24 billion in debt. If this could be a struggle. I mean, next year they're going to have to probably get some more debt, and this could take years for them to deal with their issues. Okay. Georgia on my mind. So let's switch now to discount rates and why, in a sense, is the market at 30,000, and do we think it'll stay there? So what happens to the world if the U.S. goes full socialist? The discount rate, we talked about this a little bit last year, the discount rate is going to increase, right? And so here we have, and I think of the line from Tropic Thunder where the one actor, I forget says to the other actor, he's like, never go full, well, he says something other than socialist, but never go full socialist. So America going socialist with open borders would ignite a mass immigration crisis around the world. In my opinion, leftist programs would stunt growth across the world, energy blackouts would be common, and a return to maybe a pre-1890 living standard if that were to get so exaggerated. China would likely accelerate its expansion and totalitarianism and pressure Hong Kong and Taiwan. I think Taiwan is definitely something's going to have to watched over the next couple of years. Investing discount rate would inevitably increase. Risk and the discount rate. I'm just talking about the Biden economy and a Trump economy. The lockdown risk means no sales. Think about the bars and restaurants. I'm thinking that based on Biden's statements, that probably talking about 2 to 4 months of lockdowns. We'll see if he actually does that. He may signal that he's willing to do less. Trump, of course, would have none of that. Higher taxes risk under Biden. He's already said he's going to increase taxes. Trump was talking about lowering taxes. The higher DC regulation risk. Biden will probably go back to some of the Obama tactics, and Trump is trying to deregulate things. The 25th Amendment risk, where a person is viewed as not capable of fulfilling the requirements of the office. I think you have to say that there's some risk. How much is people at CNN can debate that. But some risk under Biden. There's no risk under Trump. The socialism risk, I would say, very reasonably high under Biden, particularly if they get Georgia and the 2 Senate seats in Georgia. And on the Trump, that wouldn't be an issue. Inflation, which would be social spending risk, yes, under probably both of them, actually. And the world at war risk depends on the China and Iran policies. And I think the Trump policies have shown that he's actually breaking peace out in the Middle East and in the Kosovo area, which has, I think, been very understood in the United States and is really wonderful. Environmental policy risk, none under Trump, very high under Biden. And this one, how corrupt are the U.S. federal institutions? We're running out of time, so let's just skip this. But there is clear evidence that, we basically in this election, for 4 years now, we've seen the CIA, the State Department, the FBI rail against Trump. He's been spied on, and now the tech giants are censoring real news, and obviously the public media was highly negative on the current president. Paris Climate Accord. Does the planet Earth benefit from Obama's Paris Climate Accord? So a return to the Paris Climate Accord strangles U.S. growth while China continues on polluting. That's basically the view of a lot of us. The IEA says coal accounts for 46% of global carbon emissions. China is the world's #1 carbon emitter, accounting for 25% of the world's CO2 exhaust. As of July 2019, China had 4,436 operating coal plants, with 487 under construction, with several hundred more in permitting process. So they're going to basically exceed 5,000 coal plants in probably within the next 2 or 3 years. By comparison, the U.S. has 1,291 operating coal plants, with none under construction and only closings plans. We may soon find ourselves under 1,000 coal plants in the United States. Also ignored is that the U.S. switch from coal to natural gas has led to the U.S. having, and I'm quoting from the IEA at this point, saying having the largest absolute decline in carbon emissions among all countries since I think it was 2016, I think, or 17. By the way, the electric cars, which we charge from electricity generated by power plants, on average get 33% of their electricity. Peter's laughing. It's from electricity from coal plants. I mean, I drive an electric car. I'm saving the planet. Yeah, well, we're burning coal to drive your car. I'd rather you use natural gas. And once again, I've mentioned this in prior. We should be using. The world's fleets are slowly starting to change to liquefied natural gas, which is natural gas frozen, to serve as basically gasoline. That has to be the way of the future, not electric cars running on coal. But if we can move to that, we'll have lower emissions, and that would all the fleets in all the states, like buses and that's inner city buses. Then China should be doing it. That seems a lot cleaner. But you have to frack to get that. Industry bellwethers, let's just talk in summary. The oil and natural gas are down about 40%. The fertilizer for corn somehow was up. Radio broadcasting inexplicably was down. I don't know, maybe that was more to do with the company that we chose. But everything else, lumber was up, home builders were up, steel was up, Walmart was up. This was from beginning of the year to now. And hospitals should have been higher, but we're only up 3.5%. Again, I think of the hospitals as an oligopoly. We're reasonably bullish on hospitals. And the insurance would be down 7%, and I would expect insurance companies to be concerned about their exposures going forward. The tech titan stocks, Google was up a mere 36%, Facebook was up a mere 34%, Amazon was up 72%, Apple was up about 60%. I didn't put Twitter on the list. So someone was asking, why did you put Twitter? Who knows if Twitter's going to survive? I don't, you can't go censoring the American public and expect to stay in business when there's other competitors out there that won't, that are saying they won't do it. I don't think that's going to, we'll probably find them on the bankruptcy list in a couple of years. Hospital stocks. I'm surprised they didn't do better. HCA was up 3.5%. Community Health had a big year. They're up 300%. I think there was some maybe some acquisitions planned there. There's unique circumstances for that community, for that set of hospitals. Tenet has not recovered back to its beginning of the year. That might be something to look at. And Universal Health, same situation. The drug stocks, none of them have really done well. In fact, on the Obama years, when I guess with the Obamacare and they were sort of guaranteed payments, every one of these stocks was usually up 20% a year. And we did that for 5 or 6 years. But Trump had been talking about lowering pricing and making the pricing in the United States equal the average of the world pricing. So what drug companies have been doing for years, and it's reasonable or not reasonable, they recover, they charge high prices within U.S., and then they, because markets in the rest of the world can't afford the same prices, they lower the prices in the rest of the world. That's why probably a lot of people in this audience know of somebody from Canada or some company in Canada that ships in their cheaper pills, and they say it's the same, the same Lipitor or whatever that we get here in the United States. In a lot of cases, it is because of the different drug pricing policies. President Trump was after that and wanted to change that policy under his American First plan, but obviously it cost them, right? Because Pfizer held back the vaccine announcement. They could have announced it a week or two before the election. They chose not to, allegedly. In fact, this is not alleged, that the first call they made was to the Biden people on the Sunday before they made the announcement. And so the question you might ask as an investor is, will the next administration owe some favors to Pfizer in particular and some of the big drug companies? And since this was one of the worst years since Obamacare, which was Obamacare, so will the stocks be higher next year as they release the pressure from these drug companies to say, hey, not so fast. We don't have to do the Trump policy of America first. Let's just, you guys just continue to rape and pillage, and we're okay with that. Let's get these stocks up next year. So I don't know, maybe it's a buy recommendation. So, Peter, we're in favor of raping and pillaging, right? I mean, where's the medieval times? So what to watch for in 2022? Oh, Peter's saying no, you can't say that on TV. But Google's already banned this thing. That's why I put the Tech Titan thing. I'm never going to get this thing is not going to get any play. I think it's censored already. The results of what to watch for in 2021. The results of the Georgia 2 Senate seats runoff elections will determine the fate of the United States. If Democrats control the Senate, expect rapid action to move the policies of the U.S. to the hard left. The left learned a lesson from Obama's first year. Remember Obama's first year, but it ended suddenly in December, right, of 2009, because when Obama came with his landslide election, he owned the presidency. Obviously, they had the Senate, and they had 60 seats in the Senate, but Ted Kennedy had just died, right? So Ted Kennedy had a surrogate until the runoff under their state laws to he had the seat until there was a runoff in December. And So from basically January to December, he had a filibuster-proof Senate. He had control of the Congress, House of Representatives, and he had obviously the White House. And they only passed the beginnings of Obamacare through that, and they had to jam that through. But all these other things that they talk about, the left talks about, gun control, packing the Senate, the Supreme Court, allowing 25 million people to become naturalized citizens overnight. They could have done all of that in 2009, and they either dilly-dallied or they listened to the moderates in their Democratic Party, and who said they were going to get slaughtered if they did any of those policies. Because guess what? I mean, Democratic states also are against gun control because they have farmers too. So. But this time, I think it's going to be different. This time, they see what mistakes they made in 2009. So if they get these 2 Senate seats, you can just jam everything through, and then whoever loses at the next election, whatever Congress they lose, they lose. But the damage will have been done. That's their plan. So we could, if the Georgia goes the wrong way, it could be open borders, high taxes, larger social spending, and treaties to Iran, Russia, China. Of course, that'll be a Russian hoax. Free tuition, free health care, debt forgiveness on tuition, less policing, higher crime rates. If Dems win both Senate seats, the market will logically sell off big, in my opinion, and the market could decline by 20 to 40%. That's really the upshot. Similarly, if the Republicans retain one or both of the Georgia Senate seats, then the market will be much calmer as it's been acting right now. The press and big tech censorship will continue until such time as Congress breaks them up, as they once did in the 1890-1910 robber baron period, and then as they did to AT&T in the 1980s, which might have stretched into the 1990s. We would not expect the Biden administration to do this, but that's got to be coming. I know that's probably why Elizabeth Warren is not in the administration, because, one, she can't give up the Senate seat, but the tech people are adamant against having her in power, and we'll see how long that lasts. But so there is some commonality between the hard left of the Elizabeth Warrens and the conservative right. It is hard to see how a presidential candidate who struggled to speak extemporaneously, appears tired, has a brewing cash for access scandal with extensive documentation floating around, and a hard left anti-law and order power base that were critical to his candidacy can effectively lead the United States. And with that, it seems like there'll be a very turbulent year ahead. In conclusion, then, I view it as a tough year ahead. Proceed with caution. If the 2 Senate seats go Republican, it'll probably be a little bit calmer. And that's kind of where we are. And I guess I'm saying it would be great if the radical media could ask real questions of the next administration. And it would be an optimistic sign if Congress finally takes up serious tech censorship and moves to break up Facebook, Google, Microsoft, and eventually Amazon. And so it sounds political, but right now in America and investing, politics is what you're looking for in investing, and particularly with the 2 Senate seats. The country will change depending on if Democrats take both seats. That would be my prediction. Again, they could take both seats and the country won't change. I think that's a bad bet. But if Republicans hold both seats and it is supposedly a red state, then things will be a little bit calmer in the markets. And I think the market's already signaling that. But again, no one knows. No one knows how that election is going to happen. And so try to wrap up what I thought was a very, very intense year, and obviously a terrible year for the country at large. And those are my thoughts. Thank you.